This is Tim Phillips, Chief Investment Officer at Phillips & Company Advisors. I'd like to thank you for taking the time to review our Q3 2025 look ahead. Please read all the disclosures carefully. The U.S. economy is showing great resilience, and underlying all of that is the consumer's persistence. The consumer is showing tremendous persistence driven by several factors, one of which is wage growth. While moderating, wages continue to grow at above trend, supporting spending and savings. Beyond wage growth, the economy continues to add more jobs with no sign of significant job losses. In fact, higher income jobs in healthcare, averaging about $32 an hour, are the largest contributor that supports that resilient consumer. Now, with the boost to wages and jobs, the consumer is saving more. The consumer has about $300 billion in savings that can be unleashed to boost consumption. Really, the only gap in the consumer is their mindset. Consumer sentiment continues to bounce off multi-decade lows. The uncertainty around tariffs and geopolitical risks are on their mind. Speaking of tariffs, it's really so far been much ado about not so much, and I emphasize so far. The expected Trump tariff rates announced are significantly higher than what's been implemented. We expect the average tariff to be below 10% when all said and done. Now, according to a recent Fed study, tariff-induced price increases occur very quickly, within days or weeks, according to the survey. So we should have seen some of that tariff activity in prices, yet we haven't. And one reason we might not be seeing rapid price increases is businesses are adjusting to the tariff regime in a combination of ways. Some perhaps just modest price increases, some might be adjusting their bottom line, and many are cutting costs. The other reason is much of our consumption, over 60%, is in services, not goods. Services aren't subject to tariffs. That certainly has provided a macro dampening effect to the pricing pressures consumers could face. I get asked all the time, how is it possible inflation's cooling with all this tariff pressure in the marketplace? Well, both measures of inflation, CPI and PCE, continue to show moderating inflation. One of the main contributors is a reduction in housing costs, specifically rents. Rent inflation is basically at a standstill, and in many markets, rents are adjusting downward. The other contributor, as I mentioned earlier, is goods inflation, and that's been deflating in the past, and prices recently have barely budged on goods. Now, when you consider China's deflation problem, they continue to lower goods prices to keep full employment. In other words, we're basically importing goods deflation, which should moderate tariff policies and their impact on inflation. The good news is rate cuts are coming. The federal government is facing a debt crisis, or more like an interest rate crisis. With an average interest rate of 3.2% currently, any refinance will be challenging for the federal government budget at the refinance rate of 4.4%. That's over 100 basis points higher. And with over 50% of all federal debt maturing in the next couple of years, rates will need to come down to support refinance activity alone, not to mention any new debt needed to finance the current tax cut bill that should be passed by Congress very early July. The other real reason we need it is the economy is operating at or near the Fed's target for both unemployment and inflation. That should give the Fed the impetus to cut rates in Q3. Again, you can see the dot plots suggest the Fed does expect lower rates later this year, a cut in Q3 and a cut in Q4. Let's shift to U.S. earnings growth. U.S. earnings growth remains robust with Q2 earnings per share growth over 15% and double-digit growth for full year 2025. The S&P is still trading at or above trend valuations on a 5 and 10-year basis. That premium valuation will continue to create market volatility in the early part of Q3 or until we see actual earnings reports, and those should start in late July. Regardless of earnings growth, equity returns grind higher. It's counterintuitive, but investors tend to drive positive returns over 70% of the time, regardless if earnings are up or down. In fact, some of the best returns happen when there's a contraction in real corporate profits. It's equivalent to buying the dips with earnings. Developed markets have had a short-term earnings boost. Now, earnings growth in these developed markets, Europe and Japan, for example, are more of a function of weak year-over-year comparisons versus a resilient consumer like in the United States. Valuations are certainly more favorable than the US. However, macro growth conditions are not conducive to sustained earnings growth. Highly socialized cost structures, higher taxes, stale capital flows, along with a trade war with the United States, puts developed markets and Euro area GDP growth barely in the positive. We continue to be underweight developed markets. We expect emerging markets to continue to rebound. Earnings growth for emerging market companies are in transition, coming off a very large 2024 growth period. Full year earnings per share growth at 17% represents a compelling opportunity. With valuations at nearly half the United States valuations, we maintain our policy exposure to emerging markets. Macro emerging markets GDP growth is over 2 times developed markets and more in line with US GDP growth. The real surprise to the upside is a Chinese consumer that has boosted retail sales for 2 consecutive months, which could bode well for emerging market stocks as a whole and China in Q3. Your valuation dashboard, you can see just about everything from asset class, region, and asset size are overvalued. With the exception of energy and real estate, it makes for tricky investing at this point going forward. In summary, we believe the Fed will cut rates in Q3 and lift this restrictive interest rate policy from the US consumer as job growth continues to moderate and the consumer sentiment continues to deteriorate. We do still expect the consumer prop up corporate earnings, but they'll need more clarity around tax cuts and tariffs before confidence improves and we unleash another wave of animal spirits. We expect US trade wars with India, China, Europe, Japan, and Korea to be resolved in Q3, and that should give the consumer and the Fed room to make decisions that could boost consumption. So what we're going to be doing is reweighting US large cap growth and small cap to benefit from rising earnings and moderating financing costs. While portfolios suffered from a miss in emerging markets and MLPs due to higher for longer rate picture and the uncertainty around that interest rate trajectory, we see those clouds lifting in Q3 and maintain our modified weights to emerging markets and MLPs. Again, we're more moderate in duration to the midpoint of the yield curve with about 6 to 8 years of exposure. Again, thank you for the time you took to listen to our Q3 2025 look ahead. If you have any questions or comments or feedback, please connect with your advisor or you can email me at my email listed on this page.